Hey everybody, hopefully you're having a good day. My name's Andy, my channel is Finding Value. Today we're going to talk about we'll call it the paradigm that I view this world in. And I think it's important because, I was watching, this is a while back, I was watching a movie, I think it was like January this winter. I rewatched Avatar. It was Avatar. And the one person says that I see you, but it's deeper than the skin. It's deeper than what you physically see. You're seeing past the outer layer or outer skin, and that's kind of how I think I'm viewing the markets. Is I'm looking past the prices. I'm looking past the outer layer, getting to basically the fundamentals of the markets and the conditions of the markets. The conditions of the markets, and I'm seeing all these conditions out there, and I'm going, man, if I can tie this together, we've got a serious problem. And I do think we have a serious problem in front of us, and there's going to be ramifications of that problem. And what I'm trying to do is I'm trying to position myself to profit from these market conditions. And if you can get it right, I think we're probably going to see a one-time largest bull market in some of these items that we've ever seen in the past. And I think it was Michael Oliver was talking about chaos theory, how things aren't going to be moving in linear fashions. They're going to go parabolic. He was using that in relationship to precious metals, and I agree with him. But there's a whole bunch of things out there that, they're rhyming with history, they're repeating, but there's a lot more bullishness behind this move. I think it's got its own unique taste, so to speak. Now I'm going to go over some just headlines, and I want you to tie this together. And it deals with supply, it deals with demand, which is your market deficits. That's really what I'm looking at here. And then we're going to look at some prices. We'll look at the superficial scratching, on the top layer to see what that looks like. And then I'm going to tie some things together. I'm going to tie it together and see kind of what's going on here. So let's take a look at this. Here we go, guys. So what I've got is I've got some articles here. I'm going to start reading them off, and we're going to tie this together. It says Fact Box. This came out January 2022. World faces shortage of lithium for electric vehicle batteries. Okay. November 2021. Copper project pipeline. Project shortage to see supply lag demand post 2025, which means we'll have shortages of potential copper deficits. Could aluminum stockpiles disappear by 2024? Trafiguro thinks so. Aluminum is a very bullish story. The head of the aluminum trading said in the interview, you could see parabolic spikes once stock runs out. Now look what he said here. The deficit is now moving at such a speed that it's unsolvable, actually. Unsolvable. So, and this is the out of aluminum. This is the global inventories will be exhausted by early 2024. So you run into a deficit, and then the inventories go into a deficit, and it's game over by that point. And I'm just trying to piece this all together. If we're looking at this, we could have shortages of copper. We have shortages of aluminum, lithium. Now let's keep diving in here. It says nickel shortage worsens to hurt global industries due to Western sanctions of Russia. Now let's look before the sanctions. Nickel demand to outstrip supply by 2024, causing headaches for EV manufacturers. We go over here to the rare earths. The rare earths are controlled mainly by China. And I know this is a little bit old. It maybe goes to 2019 or something. But China is the dominant factor in controlling rare earths. We look at oil. It says, when we say demand will exceed pumping capability, what do we mean, and why is this so unprecedented? While it is true that demand has exceeded supply many times in the past, it has never, according to our models, exceeded pumping capability. What's the difference? Supply is the amount of crude produced and sold into the market. Pumping capability, on the other hand, is a more subjective term that refers to total supply that could, in principle, be produced quickly with minimal additional capital spending. Therefore, while demand has exceeded actual production, most recently in 2006 and 2008, and in 2020, there has always been the availability of additional spare capacity. This will not be the case as soon as the end of next year, which is 2022. The consequences could be dire. Wow, that's a profound statement with the pumping capability of oil. Now, looking at some more things around the world. Wow, Belarus has a 40% market share in global production and export of potash. While Russia only has 16.5% market share of global exports, it manufactures ammonium nitrate, the key ingredient needed for the fertilizer, and has close to a 66% global market share in its production. We've got Doomberg. This morning, European natural gas traded at an energy equivalent price of $620 oil. Then we look at kind of a bigger long-term look at some prices. This is corn, soybean oil, soybean meal, oats, rough rice, soybeans, canola, and wheat. What do you notice there? Vertical, 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 vertical. It's all going up vertically. Now, we're seeing these incredible price spikes in coal, natural gas, oil's starting to partake in it. Gold and silver haven't taken off yet. It's going to happen there. We are going to have shortages, demand supply market deficits all the way out to 2030. The supply is declining, projected by Barrick Gold. If we get kind of peak production in some of these other ones like copper, nickel, and all these other ones, silver's probably going to be next with it. Platinum's already peaked 2006. The investment there and the time it takes to put up a new mine is going to take some time. So when you start piecing this all together and we look past the skin is just what people are interacting at today. That's the price today. If we look past it, past in time, we've got all these deficits out there. Now, what are the ramifications of these deficits? What's going to happen? If we're seeing all of these prices go vertical, what we need to be looking at is what hasn't gone vertical yet. Uranium. Uranium is an incredibly good deal. Now, how could we play this uranium and what could the ramifications be with the market conditions that we have here? I'm saying that we could have potential shortages everywhere. What do they want to ramp up? What do they want to ramp up? They want to ramp up renewables, right? There's some barriers there to ramping those up. I just read aluminum, copper, nickel, lithium. There's all these different things that they may not be able to ramp up electric vehicles. They may not be able to ramp up solar panels. They may not be able to ramp up the wind turbine engine or wind turbines. They might not be able to ramp this up because of mineral shortages, at least at the rates that they want to ramp them up with. And if the shortages get dire enough, there may be other ramifications, tertiary effects, where we'll say if things get short, maybe China doesn't want to release their rare earth metals to America, or maybe they don't want to give any other Europe or whomever the rare earth metals. Maybe they don't want to process for us. I don't necessarily know. I'm just giving examples. In this type of scenario, what happens is if they try to go to, say, coal or natural gas, they're already to the moon. That's not an option. So what other option do you have left? You have uranium, right? You have nuclear power plants that are already built that don't have shortages per se. Perhaps they need some, which is very few minerals, to get those back up and running. So the existing infrastructure is in place. The existing connections are in place. The existing minerals are in place. The energy that went into building those existing nuclear power plants are in place. And some of these that they may take offline might not come offline. Do they have uranium for all of those nuclear power plants? If coal is too expensive to go to, if natural gas is too expensive to go to, if the minerals are not there in the quantities needed to ramp up renewables, basically they're going to have to fire them back on. They don't have a choice. Now, do you think if they don't have the uranium for those, do you think there's a bunch of uranium inventories sitting around in this world just waiting to be tapped? or to be moved from one inventory to a nuclear facility, I don't think the inventories are there. That means that we are limited to what the supply is coming from the mines. And if Kazatomprom comes off, good luck. They're going to try to ramp something which they can't ramp because there's no uranium available. It's called a big squeeze, just like natural gas is happening and just like coal is happening. I think it's going to transfer to uranium. I think it's going to transfer to gold and silver. I think it's going to transfer to a whole bunch of different things. We could be seeing shortages of a whole bunch of different minerals post mid-2020s, 2025, 2026. This is going to get real ugly. And I'm positioning my portfolio for a world that looks like that. That's my paradigm. I'm looking at all of the charts through these. This is the paradigm I'm looking at. Everything's blowing up everywhere. Where do you go in that type of market condition? Well, if energy's having a crisis, I think energy is probably a good spot to be hanging out in. Maybe some of these vertically integrated companies, aluminum, China, I know that one's in China, but it's a vertically integrated company. And if we have massive shortages of aluminum, they're going to make a lot of money for a period of time. Now, I don't know about nationalization, wars, all that stuff could come up. It very well could. And I don't have that crystal ball that I know all that stuff. But I can spread out, I can get, exposure to some of this stuff through royalty companies and whatever else. And that's the best that I can do is position given this paradigm. I can buy physical precious metals, which I've done in copious amounts. And one day you'll wake up and you'll say, you know what, I think I've got enough. I did that once. I kept buying more and more and more and more because I didn't feel like I had enough. And then one day it just felt like I had enough. I don't know what it was. And everyone's threshold is at different levels. Some thresholds are a couple hundred ounces. Others are tens of thousands of ounces. But if you're accumulating physical at some point, at least me, I felt like I had enough. And this picture that's being painted here, I'm not trying to scare anyone, but it is a little bit scary. It is scaring me a little bit. It is. And I just think that energy is getting energy in general, and things that are very energy intensive, that have a lot of energy already sunk into a build or whatever, is going to fetch premiums. That's what we're seeing with the used car market. When shortages happen, the things that have existing materials, minerals, and energy embedded into it are going to become more valuable. And I think the ones that have the most energy embedded into it, that have value, that product has value, will become more valuable. Because your barrier to getting that thing is becoming greater and greater with time. You can't just go buy one. It won't be there. So ones that are very complex, like a car is very complex with a lot of components and different minerals in it, I think they're going to be, it's going to remain high for a good period of time. I think that built homes that are completed, if you can't build a new house and you're kind of stuck where you can't get the minerals or you can't get the home completed because you got shortages of things, it's going to prevent a lot of new homes from coming on. Now, is that going to be not as inflationary? Maybe not. I mean, we're seeing a lot of, at least these are projections, a lot of projections of deficits, very large deficits in the future. And I can name off even more than what I showed here. Cobalt. It's cobalt, nickel, copper, platinum, palladium, rhodium, silver, gold, graphite. I mean, we can go on and on and on. It's like every mineral that is used somewhere seems to be going into a shortage because of maybe it's lack of investment, maybe not. Maybe all the good stuff's tapped. And then if you keep in the back of your mind that the ore grades continually decline and that the energy input costs, not input, but the actual energy used is going to go vertical, that's another barrier to extracting this stuff out. And technology, as technology progresses, I know people think that technology is going to save us. All it does is it allows people to populate even more. It puts us in a more dire situation if we cannot get these minerals and potash and food production and all these things up. I mean, food production could be another one that could be quite dire. If you have an oil crisis alongside a food crisis, that doesn't seem good. And then, other investments in agriculture, the actual seeds, genetically modified seeds that can be planted and grown in adverse soil conditions because we don't have the potash and fertilizer to go with it. Maybe having fertilizer companies in a stable jurisdiction is good. Like, I don't know, United States is getting pretty bad, so is Canada. But I'll take my chances in the United States at the moment. So, I mean, I'm just trying to paint this picture, and it's like the squeezes here that could happen could be so dramatic and so fast that trying to trade in and out, I don't think's the proper way to do it. I think you just understand, look past the prices, look at the potential of the moves and the supply-demand deficits and the supply coming online, and the balance being the inventory. You look past that skin, it's like, how can I not be in commodities? How can I not have a stake in this stuff? And that's what I do, is I have a stake in it. And I'm positioned, it's playing like a chess game. You position out, and I'm just waiting for checkmate to happen. If you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.